OPEC, so we might just park that until the sort of second half of the segment. But let's kick off Week in Review with Christoph Ruhl, regular Sunday commentator, senior research scholar from the Center on Global Energy Policy at Columbia University. Christoph, good morning. We have completed yet another week where this oil market, these oil prices seem to just want to go higher and higher, and there's really nothing holding it back at this stage. Your thoughts on the week past?
Morning, John. Morning, John. Morning, everybody. I'll be brief because I'm also interested in what John has to say. I think there's two big topics here. One, you mentioned it, oil price going up and up and up. And then the topic, of course, is not so much that because we can explain it. The topic is where is shale? And we have seen shale lagging behind what people had anticipated, including yours truly. I thought they would come back much faster. It's clear why, because they haven't invested that much. You can see that on the rig count, which is rising. So the question is, why didn't they invest? And there is sort of a mix of things here, but there's two broad themes which I think are important and will keep us busy over the weeks to come. One is, they haven't invested because the investment climate is so bad with the energy transition and everybody vilifying oil and gas investments that capital constraints are just biting and there's not enough money willing to go into oil. The second is they haven't been invested because their investors after financial restructuring, just for the good old profit motive, are wary of investments. They want to see rates of returns. They want to see stability in the oil price. They see an oil price held up by purely political factors, that is by OPEC. And so it takes them a little longer to come online. In both cases, I would argue it's not out, it's just a delay. So shale is going to come back, most likely, when I look at the rig count now, in the first quarter of 22. But this issue, whether the investment climate has deteriorated so much in oil and gas that Western companies don't invest, and therefore, as the IEA has laid out in this scenario, majority of investment in the future will come from OPEC countries. They said 52%. That's a real issue which will be with us for a while. Second, the Fed, more and more noises about interest rates, now zeroing in on 2023. There is a notion which most of your listeners will not have heard before, but which is important, and I would recommend everyone to familiarize himself with it. It's called the dot plots, the Fed dot plots. That's a survey taking with all the members of the Federal Reserve Monetary Policy Committee. That's the committee setting rates. And what happens here, very transparent, is that they ask every committee member, what do you think the policy rate should be in, say, 2023 along a time axis? And then they give their opinion. They say 0, or they say plus 1% or plus 3%. That's going to be published. Anonymous, so you can't attribute the plots to the individual members, but it gives you a fairly good picture. When we look at the latest one, all of them have moved up, and they're all now in 2023 anticipating rate increases between somewhere 1%, 1.5% with a wide range. But basically, the notion that almost unanimous, they think that rates will go up in 2023, that's a clearer sign, and that explains also this humbling of talking about a meeting, talking about interest rates, which we have heard. So that will accelerate, and the question is, can the Fed sort of continue walking the tightrope of telling markets it's all fine, the increase is only happening because everything's under control, or do markets at some point panic, or do markets at some point saying, okay, I've made enough money, I sell off, that's too uncertain for me, and create financial instability. So these are the two big themes. When does shale come back, and what will OPEC do in reaction? And when will interest rates go up, and what will markets do in anticipation?
Well, let's welcome John Defterios, former energy markets editor and anchor at CNN, and now the chairman of the Agora Group. John, there does appear to be what you would think are somewhat restraining trends emerging for this oil market, but yet it keeps moving, most notably a serious compromise in the U.S. on the infamous infrastructure bill, which started at over $2 trillion, now seems to be compromised down to $1.2 trillion. That in itself is a sort of half the stimulus the market may have been expecting. Your thoughts on where the oil markets are moving versus these restraints, as Christoph also references, the inflation?
Yeah, I think, Christoph, you have a really good outline there, Sean, in terms of what the market's feeling from the Federal Reserve here. But I think the long-term trend is that the Federal Reserve is not going to let the market or the economy tilt off the edge, right? So they're going to be accommodative, just not at the levels that we've seen before. And I think that infrastructure bill plays into the narrative what we're talking about here. The original target was $2.3 trillion. And I think they actually did Joe Biden a favor by letting him put a framework forward that it's much higher than the number that's there. $1.2 trillion is not a reality. This stretches over 8 years. And you remember the last time we talked a month ago, I said this is classic U.S. pork barrel politics, if you will. It is on the infrastructure, the roads, the bridges, the rail networks, trying to build that out, which needs a major facelift. What's not in there is the advancements on the green infrastructure that Biden was looking for. And he plans to circle back, by the way, Sean and Christoph, to get more of that in the years to come, and with higher corporate taxes, which could serve as a drag later on growth. So it's interesting. They did let him come forward with this bipartisan committee, 5 senators from the Republicans and 5 from the Democrats, and say, okay, we have something on the table here. He doesn't feel the game is over. I was in Washington for my 10-day kind of amber sit out, right? So it was interesting to get that perspective as that negotiation was going forward here. The progressives were not happy with the Biden approach here, because this was supposed to be the great jobs bill at the same time. But seeing what the Fed is finally changing its position here, Sean, you can't overstimulate. Remember, we talked about the percentage of GDP put into stimulus. I think everybody's starting to say, okay, this is enough. So Biden walked away with something. He doesn't feel the game is over. And then the other thing I think it's interesting, as I'm now in London right now, you look at some interesting figures. The rents accumulated on the corporate side here, and I think this is something that's going to play out with slower growth in 2022. They're only collecting on the commercial rents 1/5 of the total rent so far. So the debt is accumulating because we're not seeing a lot of spending. The traffic is not there. So the influence of this work from home and what's happening on commercial rents, for example, in the heart of London, same thing in Washington. If you walk through downtown Washington, or the same thing in London right now, it's empty. So this is that balancing act by the central banks. How do I maintain this momentum as we start to open up again? But underneath all of that, what is the real demand, and the real demand for energy? And this is a constraint-driven market rally. I mean, $76 a barrel on Brent, 74 on WTI. It's there because there's still oil off the market. So as you suggested at the opening of our discussion today, very eager to see how accommodative the OPEC Plus group will be on July 1. I don't think they're going to overreact, but they want to send a signal that they're sensitive to not killing off the rally at the same time.
Christoph, you mentioned there that the how the market adapts to the inflation, the tapering on the bond side, the central bank side, if they curtail their bond purchases. Ultimately, the noise from the Fed from the time of their meeting 2 weeks ago, and then the cleanup by the Fed chairman last week, the markets seemed to initially take the hit and then have now recovered back to hitting records nearly every day. I'm talking on the equity markets. It seems the risk-on appetite is still very solid despite the signals from the Fed.
I think the market has reacted very, very moderately. Almost not visible in the long term. It continues to go up, and what you see there is the wall of money. Right? This is just the fact that there is so much money, I mean, billions and billions spent by the Fed and other central banks unabated every week into buying paper, including commercial paper, into transfers. And John is right on the stimulus scale down, but that's fiscal policy and is over years. The wall of money and monetary policy is with us. And as long as that is the case, even if markets react very adversely, they will bounce back because people will have to put their money. And you look at house prices and you see that. It reminds me a little bit, there was a similar situation after the financial crisis, during the European crisis, when there was this game being played between Greenspan actually and the markets, which was almost like every time there was bad news, the equity markets went up because that would mean that the easy monetary policy of the time would continue. And that easy monetary policy of 2011 and 12, that was peanuts against what we have right now. And so right now volatility is less. I would expect as tapering starts in earnest, a lot more volatility, but I would expect also the upward drift to continue. And remember, where I'm standing from, the inflation problem is not so much the temporary problem, it's the long-term problem of this debt buildup, which has to be paid off, which will lead to a sort of silent understanding between the main actors that if volatility can be controlled, 3-4% inflation may not be a bad thing for a while.
John, the other thing that was buried in the Fed statement recently was a raise in the economic projections for the U.S. economy. Previously, it was a 6.5% GDP growth for 21. They raised it to 7%. So clearly, the engine of recovery in the U.S. is deeply anchored. But my question to you, John, your thoughts on what it means for the emerging markets. I mean, the big part of the global demand growth, the marginal growth of oil and energy is in Asia, is in the emerging economies. I'm wondering, what do you think is the domino effect of this sort of starting to talk about talking, and how that plays out for the emerging markets and demand?
Yeah, it's a fantastic point, Sean, because I saw one on the News Digest here. They were almost at the end of the road for the emerging markets, right? They had this 18-month projection that they're going to recover and it's going to be kind of hunky-dory for them and a clear line of sight. And you go back to the traditional scenario here and the dynamics in the market. When the Fed starts to act, the emerging markets start to feel the pain. So I don't think it's going to be straight line up for them economically going forward. So if we do not have this full-blown recovery, I think there's a lot of pent-up demand, though, in the G7 economies right now. That's the sense you get in Washington. As Christoph was saying, if you look at property prices, again, in the G7 economies, but particularly the US and this recovery, people are trying to deploy their assets as much as possible and look for returns. And you see it in the real estate market, again, in the UK, and you see it in the United States right now. I don't see that. I know China's pretty on stable ground here. I don't see that same scenario in the other emerging markets of the world. And this is a question mark, I think, for the members of OPEC Plus when they sit down here. Is this a Fed-fueled recovery right now, and we have to kind of look through the lens of the G7, or do we have to look in totality and suggest that we don't have that robust demand coming from Southeast Asia, from Africa, from India, which is still struggling with COVID right now, and we do not have the free movement of travel. I mean, I was going to say, in my return to Washington, it was pretty smooth sailing. You can come in, and because of the vaccination rates, they were pretty loose. That's not the case in the UK, right? I came back, you had to do 3 rounds of testings. It's very restrictive. The track and trace is very aggressive. There's a whole debate for those who are sitting in the Middle East about which European Union markets open up for the tourism season, which is a big growth driver, right? So you have a debate amongst the Greeks, the Italians, and the Spanish, whether we can open up, and you have Chancellor Merkel suggesting that we should put a 14-day quarantine on UK travelers, right? So there's strains within the European Union, which I think is going to actually hold back growth when it comes to consumer movement and business movement, at least for the next 3 or 4 months. And as many are talking about again here, and this is something OPEC Plus is paying attention to, I think that we could have a very brutal winter because of the Delta variant, that it's a reality. I mean, we're looking at 14 to 16,000 cases a day in the UK. And if you walk the streets of Wimbledon here and the tournaments coming forward, people want to spend, they want to go to restaurants, they want to get out. But then if you go into the city center and then you look the movement of business, it's not there. So there's frustration that they cannot move out and about. So I think it's going to hold back European growth, is my point.
It'll be interesting.
Yeah,
Go ahead, Christoph. Yep.
Yeah, I think John makes 2 interesting things worth getting in, points worth getting into, which are right. And one is, we shouldn't think of G7 versus rest of the world, because within the G7, there are splits also occurring. The US undoubtedly is growing, and I think the UK, depending on their attitude to the pandemic, will go either side. Europe, I'm not so sure. Japan, I'm not so sure. That's not very strong. The other question is, if this is now the volatility I described sort of on the surface driven by the Fed, and there's a long-term underlying inflation and debt and growth problem, the question is, where does this break into the open? And indeed, it doesn't have to be in the US. Historically, Fed policies, when they turn restrictive, might as well trigger a crisis, in our case now in emerging markets, or in the corporate sector globally, or in God knows where. And I think that the longer the party continues and the more the Fed concentrates on what happens in the US, the higher the risk that something goes wrong in emerging markets, for example, or sort of with non-AAA rated corporate bonds more broadly.
Christoph, let's just touch a little bit and make the switch over to sort of week ahead and supply, the supply issue. We talked earlier, obviously you punctuated the shale not coming as previously anticipated. It may obviously still, but we have now a story on our digest today that Canadian tar sands are back to pre-COVID levels. Of course, the Iranian story seems to have really been pushed out now, having sort of been factored into the market now. Sort of the new supply from Iran looks unlikely this year. How do you see, Christoph, your thoughts on supply, higher cost supply, non-OPEC plus supply?
I think that OPEC try to continue what they've done very successfully so far, which is to take as much money off the table as possible without derailing that rally and without undue acceleration of the private competition. So in a sense, stepping back, we're now reaping the disadvantages of having agreed in April 2020 on a cut in output, which was at least for 50% driven by state players. So now they can maintain it longer, prices will stay up for longer. Whereas if it had been left to the market, it would have been steeper, but prices would now be lower. That's the initial situation. From there, we should expect them to try to extend that. I still expect shale to come back with a delay because the carrot called high prices and money is there. And investors are not investors because they are cautious. They are investors because they want to make money at the end. So they're not policing the shale guys as OPEC polices its members. That's a wrong analogy. And I would think that at the end of the day, OPEC is about or has already discovered a new weapon which they could use against shale. Remember, we all said, okay, shale has this very fast reaction time. That changes the game. There's little OPEC can do. Prices too high, shale comes back, OPEC loses market share or lowers prices. But now it turns out that for these reasons of oil price uncertainty and also because of the energy transition, capital costs for shale may actually become a constraint. So imagine a world in which OPEC manages to create the impression that prices are really very volatile and completely at their disposal, and then let them go to 80, let them go to 30 and back to 60 somewhere. That could really multiply the constraint on shale companies. That would be, in my view, if I would be OPEC, only then would be a very tempting strategy. You let run up prices and then you let them crash. And you see how the other side deals with it. And it will deal with it very poorly because it's decentralized, it's private capital driven, and it's investors' money at risk, which now have shown that they have some influence. It's no longer these wild bunch of people going for growth, and no matter where the money will come in 10 years. It's an orderly member of economic society, and they don't like this kind of uncertainty. So that's a perspective which I wouldn't exclude.
John, I wanted to give you the opportunity. Is the first OPEC meeting in 25 years. You won't be doing a CNN curtain raiser. So here's your chance. What would be in your 3-minute CNN package? I mean, I'm kind of taken by how robust OPEC have taken a very kind of bullish posture. I thought they might be more inclined to bring back barrels quicker than go for the higher price. How do you think the tea leaves are reading ahead of the meeting this week?
Yeah, it's very interesting because Christoph made a good point there, is that this is that space in between, Sean. And when I was actually doing the reporting at the time, 2019 into 20, right, we had to factor in, there was $300 billion of debt, and we had a washout of some 500 companies in the United States. So they have to be cautious because the discipline being put onto them by Wall Street is much greater, right? So this is going to take time to rebuild and restore the shale production, which will snap back, but it's going to have to be on the merits of making a return, to Christoph's point. So they are back into the market. And I think the Saudi strategy has prevailed, not to the happiness of all OPEC plus members, by the way, that they're trying to maintain this price and make sure that they're cautious, not coming back too quickly. I see the debate on our chat room here with the holding back of 5.8 million barrels. It's still substantial. So if you actually went back and said, I'm going to put all 5.8 on the market, which they're not going to do, and if they come back in with 500,000 barrels a day, it's a signal that we're sensitive to making sure we don't kill off the recovery, but we want to be in the driver's seat. And this is the space in between we talked about the last time, Sean, we were together. If you look at the amount of money going into ESG funds in the United States alone, it's a record sum in the first 5 months of the year, $54 billion. So there's demand, even on the bond side, to park money where the demand's going to be in the future. It just is that space in between where there's underinvestment in oil and gas. As Christoph said, most of that investment is coming from national oil companies. So they feel like they're in a much better position than they were 12 months ago, obviously. But I think the management of OPEC Plus, I always go back to this and did the same thing while on the ground in Vienna. What if OPEC Plus wasn't playing, right? It'd be a much different game right now because they've come into the market and managed. They've had some hiccups. They've had some temporary price wars at the peak of the pandemic, but they got their footing. They're on mostly the same page. I think where there's a disagreement, of course, is what happens over 20 years to demand forward and the transition. Do you see what I'm saying?
Absolutely.
Some are suggesting, oh, we have a clear line of sight for the next 30 to 40 years. There's some within the OPEC Plus apparatus that say that's not the case. The transition is going to happen faster, and we're not seeing it yet.
This agreement expires in the spring of next year. So we're sort of coming into the final furlong, as they say in horse racing. The question, John, I have for you is the last time OPEC met, I mean, the last time they made a decision about adding supply, they did so with a 3-month agreement in May, June, and July. And over the course of that 3 months, it was 2 million barrels or so. Now they're meeting tomorrow. August is around the corner. So they have to map out the next month or the rest of the year. I'm wondering your thoughts. Will they go? There's certain expectation that they might move to a month to month, or would you see them putting a 3-month plan together like they did the last time?
Well, I think it's going to be the 3-month plan, Sean. It's a great question you're asking here. But the signals from Saudi Arabia, Abdulaziz bin Salman, His Royal Highness, suggesting that we're ready to act, right? Because they have to plan for the fourth quarter demand again. And then to what Christoph was talking about before, what is the Fed doing? And what are the early signals that the Fed's going to be sending in the Q1 2022? So obviously OPEC is trying to manage those expectations at the same time. So we'll give you a line of sight for the next 3 months. We'll probably act in a very moderate way now, but we're ready to respond and go month to month if necessary. I don't see any real shock surprises on the economic front between now and December, right? There's nothing in the horizon that would suggest differently, unless the Delta variant surprises us, in a shock sort of way in the fourth quarter, and with many in Europe talking about a very brutal winter because of the take-up of the Delta variant that we see. That's primarily in the UK, but it's gone into Germany, it's gone into Italy. People are saying, how is this variant spreading so quickly? That could be the surprise that leads the Federal Reserve to be a bit more accommodative and give some leeway to OPEC Plus to not overreact right now. They know that if you get over $80 a barrel, the demand starts to taper off. They're extremely cognizant of trying to sustain demand. But the figures, as you know, in the first quarter of 2022, it could be back up to where we were pre-pandemic levels on oil and gas. But the trend line I find very interesting right now, because you see, for example, as in the United States, advertisements and Europe and in the US for electric vehicles, it's just not happening as fast. So everybody knows what's in the pipeline medium term. OPEC's in the position right now to try to manage it near term and kind of make sun while they can, right? I mean, grow the hay while the sun's still shining, if you will.
Let's get the survey question in just ahead of Christoph coming in. How much new oil supply will OPEC add back to the market from August through to December, rather than just August, which we posted a survey question on earlier? But over the course of that idea that I just spoke to John about, the 3 to 4 month plan view to the end of the year, will they add to the market from August to December 1 million barrels, 2 million barrels, 3 million barrels, or more than 3 million barrels over the course of the rest of this year, August through to December? Welcome everybody's views on that, and then go to Christoph. Christoph, in terms of the issues it seemed to me that the big delay in OPEC signaling to the market over the last few months was the uncertainty around new supply, Iran, shale, and so forth. That seems to have been removed from the equation now, and they've got a sort of line of view. They only really need to make some judgment around demand. What do you think is going to be the kind of 2 or 3 top key things that are going to influence how they map out the next decision?
I agree. The uncertainty on the supply side has been largely removed. But keep in mind, including that all signs are pointing that shale will come back. at the end of the beginning of next year in a probably potentially massive way. So that's not the horizon. Now, in the short term, what they will look at is, of course, exactly this kind of, does the Delta variant spread? Does that mean that summer driving demand suffers and all these kind of things John has left out? And I think it's a direct link. OPEC will look at the Delta variant, not the Fed. The Fed doesn't care what happens in Europe, at least not officially. So it will go directly into OPEC's calculation. I would expect, that if they continue what they do, so they will make a short-term announcement only, not something for the next 3 months. Will keep as many options open as they have. They will err on the side of caution because it's not clear that demand really bounces back as strong as now everybody projects. And I would not be surprised if they pull out another card of their sleeve, something analog to, remember a few months ago when Saudi said we cut an extra 1 million, so they have something to be flexible on the side, a stick for our friends and fellow members, but also for the market. If they could do something like that and say, okay, maybe there is a flexibility here. They won't mark a red line in terms of prices, but if demand crosses certain thresholds, they will meet again, or they will keep their options open, or they will release another. So signaling flexibility, signaling that they're ready to go to rein in the rally while at the same time taking as much money off the table as possible. Unfortunately, OPEC doesn't publish OPEC.plots. That would be great. We could see what everybody's thinking. But that's not how far transparency goes. But I think they have been pretty clear in how they conducted policy, as John said, and I would expect this to continue. And that would point at these short-term arrangements with built-in flexibility.
John, is there any other factor than the OPEC meeting that you'll be watching next week? We did touch on this Biden infrastructure bill, if that gets sort of signed off. Anything else to keep note of?
Well, I think it's worth discussing the kind of relations in the bigger picture, the geopolitical dynamics there, Sean. Ibrahim Raisi of Iran coming into power. I don't expect a deal really quickly. I know the Biden administration wants to kind of level this off to kind of remove this dark cloud in the Middle East. He's a very different character than we've seen. He's trying to come forward as somebody who's a moderate and that can negotiate with the West. But I think the zebra has different stripes, if you will. So I don't see an imminent deal. And I think the U.S., and I thought this was going to happen. They had such a short window while the current leadership was into place to get that deal done. But you had to think, what is next? Well, we know what is next right now. So I think there's going to be more caution on that front. The other one I thought was interesting, there's pushback within the European Union on the travel markets that we talked about opening. You saw the Greek prime minister saying to Brussels that we don't need to follow the German way. We have to look after our own economy. That was reiterated by the Spaniards as well. So there's some tension at that level about the pace of opening up. Also, Angela Merkel and President Macron wanted to open up a direct dialogue with Vladimir Putin. Pushback from Eastern and Central Europe, the Baltic states, saying, wait a second, why are we doing that? Why are we giving him the olive branch? But beneath all of that, they want to get the Nord Stream 2 project negotiated. And I saw the economy minister, Peter Altmaier of Germany, suggesting that the US and Germany want to get that settled by the end of August. I don't want to be too cynical here, but I think Angela Merkel is trying to open up that dialogue to officially get that done with Vladimir Putin in this kind of troika with the United States at the same time. So look out for Nord Stream 2. I think there's going to be some movement by the end of the summer here. And at the end of the day, the Europeans like to travel. They like to take their holiday. They have to work out a measure here so you can foster economic growth in July and August. And that's not clear yet what that's going to look like. And I think Christoph and Sean, you alluded to this as well. OPEC Plus has been very clever about how to manage expectations so far. I agree they're going to follow the Federal Reserve. I don't think there's any shock and awe campaign coming from the Fed. They're going to try to give everybody as clear line of sight as possible. And OPEC will respond accordingly. I don't think it's going to be over 1 million barrels a day back onto the market by the end of the year, though. I think they're very cautious. I think they'll try to take it steady as she goes and not overplay their hand, knowing what Christoph was saying, that the shale production is going to come back. They don't want to be shocked that it comes back if prices stay within 75, 80. That's a good return on their investments if they come back into the market.
And they want spare capacity left to bring.
Let's just get the survey result and give Christoph the last word on this. So 2 million barrels got most of the votes for the second half, or for August to December, with 25% or 27%, as John's saying, a million, and then there's 20% for 3 million. Christoph, your thoughts on that and your outlook for the next week, other than the OPEC meeting?
I'm with John on the first one, so I think it's not going to be more than a million. I think possibly it will be even less than a million. They want to control the situation, so they will probably devise.
I mean, less than a million. I see you're well over $80 a barrel. I mean, I think less than a million is you're hitting to 90. I'd say for the rest of the year.
Remember the discussion of the fair price when it moved from 40 to 120 or so. There was always a step more. So maybe I know, but 2 million. Who knows? It depends on the strength of demand, and there I'm also with John. So I have doubts that it turns out at the end of the year as positive as it is right now. The strong numbers we are seeing are rebound numbers, but they sort of equalize. Turns out that the beginning of 2022 will be quite pivotal. We have shale, we have a new OPEC decision, the agreement expiring. We have the Feds and then seriously needing to signal whether they raise or not the year after. So that's going to be an interesting sort of settle point for all of this. Next week, I haven't looked at the details, but I don't think anything particular happens. So I would be very, very sort of cognizant of watching the European Union versus each other and the UK in terms of travel restrictions. Are we moving into an era a little bit of tit for tat, or are they getting their act together and can cooperate? Because that will give you a hint of how they can cooperate with future stimulus programs. And without coordination and expenditures, these guys will never grow as fast as the US or China again. So the gap between Europe and the two other regions, and Europe still nominally is the biggest economy of the three, will widen and has already a bit widening by COVID. And then I think that one thing which has dropped off the radar pretty much, and also because not much is being communicated, is on the economic situation in China, including its inflationary and financial sector situation. That will make its way back onto the news items one day or another. I don't think it's as stable as no news would suggest.
Well, the one thing is finishing off on China on July 1st, the day of the OPEC meeting, is also the 100th anniversary of the Chinese Communist Party. And they'll be certainly sort of singing a lot of praises on that and a lot of vision for what's to come. So China may come back very much into the news in the coming week. But listen, we'll leave it there. Thank you so much, John Defterios in London and Christoph in Germany. John, going on your holidays, getting on a plane, enjoy. Hopefully, nothing comes to spoil everybody's holiday plans, whatever they may be. But we'll be here every morning during the week. We look forward to catching up with you in the coming days. All the best. Thank you very much.
Take care.